The revenue recognition rules have actually gone through a revision in the last couple years in financial accounting. I now follow a 5-step process that I have outlined right over here, where we identify the contract, which can be written, verbal, implied. We then identify the performance obligations. Is there one performance obligation within the contract, or is there multiple? We then determine the transaction price associated with the contract and allocate the transaction price among the various performance obligations, and then recognize the revenue when the performance obligation is satisfied. Now, this can bring up some complexities when we talk about intermediate accounting concepts. For instance, let's say you went out to buy an Xbox or some sort of gaming system. And when you paid a single price for this Xbox or gaming system, you received not only the system, but also access to their internet platform where you can play games online. You pay a single transaction price, but within that contract, is there one performance obligation, or is the company actually required to perform more than one performance obligation? And if so, since you paid a single transaction price, how much should be allocated to the console, the gaming console itself, and how much should be allocated to your access or usage of the platform where you play the games online? And these types of questions can bring up complexities, and it can get a lot more complex than just that for us when we're following this new set of revenue recognition principles. But for us, in this introductory class, most of the obligations that we're going to have are going to be a single obligation that's going to be performed, and therefore the transaction price associated is going to be allocated only to one item, and therefore it's going to make the recognition a lot easier. Ultimately, our goal is going to be to record revenue when provide a good or service. Which ultimately this good or service is going to be our performance obligation. So ultimately we record revenue when we complete our performance obligation, and the amount that we record it for is the amount that we believe we're entitled to receive, or in other words, the transaction price, so long as we expect that we're going to receive payment. And this kind of alludes to a discussion that we're going to have in Chapter 8 about bad debt expense. But for right now, we'll hold off on that, and we'll just say we're going to record revenue when we provide a good or service, or in other words, when we fulfill our performance obligation. But because the timing of cash and the timing of when we record revenue doesn't necessarily have to coincide, we could have 3 different scenarios related to cash and revenue in which cash is recorded before, after, or at the same time as revenue. In order to make this more clear, let's look at a quick timeline here. I'm going to put cash on top, and then revenue on bottom. And then right here in the middle, I'm going to go ahead and note that this is where we complete the performance obligation. Okay. All right, scenario number 1 is going to be where we receive cash, we being the company, receive cash prior to actually completing the performance obligation, providing the good or service. In that case, our journal entry would be debit cash. We don't have a choice for that. We have a transaction. But our credit won't be to revenue. Remember, we won't record. Record implies that we're writing it down as a journal entry. We won't record revenue until we actually complete the performance obligation. So instead, we will credit the deferred revenue. Deferred revenue is actually a liability. Specifically, it's a current liability. And this implies that we still have an obligation. Our obligation is to fulfill the good or service. So this happens right here at this point in time, which we receive cash. Later on, we will actually fulfill our performance obligation. And when we do, our journal entry to reflect that is for us to debit deferred revenue, which would decrease the current liability, and then credit whatever type of revenue it is that we're doing. So we'll put a blank here and we'll say revenue. That could be service revenue, it could be sales revenue for providing a good, but this will increase a revenue account, which increases stockholders' equity account. Okay, that's scenario number 1, in which we receive cash prior to actually performing the performance obligation. Scenario number 2 is when we receive cash, we being the company, receive cash the same time we perform our performance obligation. In other words, we provide the good or service. Our credit is then going to be to a revenue. So again, if it was a service, we'd credit service revenue. If it was rent, where we loaned out space, we would credit rent revenue. Or if we provided a good, it would be sales revenue. And this, again, increases the revenue account, increasing stockholders' equity account. The third scenario is where we receive cash after having provided the good or service. Journal entry at this time period where the 3 is would be to debit cash. This is where we actually receive cash. Our credit, though, we're going to have to figure out by first going back to the point at which we perform our performance obligation, in other words, provide the good or service. Notice there's always a journal entry when we complete our performance obligation. We always credit revenue every time we complete our performance obligation. So we know back here at this point, there's going to be 2 journal entries required with scenario number 3. We know we're going to credit revenue because we always do when we have a performance obligation. Increasing revenue, increasing stockholders' equity. But at that point, we haven't yet received cash. In other words, in this scenario, we receive cash afterwards. So we can't debit cash. Our debit then goes to accounts receivable, which is a current asset, and this represents the right to receive cash. So once we complete our performance obligation, we then have the right to receive cash, even if we haven't got cash yet. And then when we go to 3, it becomes pretty clear that once we receive the cash, we then no longer have the right to receive cash because we've already received it. So our credit then is to accounts receivable to decrease this current asset here. And then our increase in cash increases that current asset. That's our third scenario. Okay, we can do a similar exercise with expenses here. We draw our timeline here, and we've got cash and we've got expense. But instead of noting a performance obligation, we'll say this is when we incur the expense. Expenses, if at all possible, attempt to match or follow the revenue. In other words, as we looked at over here on the accrual basis accounting, what we tried to do is match the expenses or the costs with the revenues that were generated from taking on those costs. That's what made net income a usable number. And so we often say that expenses follow the matching principle, in which we attempt to match the expenses with the revenues that the expenses help generate, right? If we can't follow the matching principle, we ask ourselves the question, when was the economic benefit of the expense used up? In other words, when did the underlying business activity take place? So when did we get the benefit of the expense if we can't match it directly with the matching principle? And that's what guides our recording in accrual basis accounting for an expense. In other words, these 2 represent the incurrence. So we'll say whenever we incur, we're going to record an expense, just like whenever we perform the performance obligation, we recorded a revenue. We're going to increase expenses with a debit, whereas we increased revenues with a credit. The first scenario, scenario number 1, says that we paid cash before we incurred the expense, before one of these 2 things over on the right-hand side happened. So we have to record a journal entry because we paid cash, and a payment of cash affects the accounting equation. So since our accounting equation is impacted, we don't have a choice. We have to record a transaction. But the debit won't go to an expense because we did not incur the expense yet. So instead, we have to record an asset. And depending on what it is, we'll say in this example, we purchase supplies. We record an asset while we wait to utilize the expense or incur the expense in a future period. Once we use up our asset, our supplies, so in this example, when we get to the incurrence piece, we've now used supplies, we have another journal entry. Remember, we'll record an expense, increase in expense, but decreasing stockholders' equity. Namely, if we're using supplies, our type of expense is going to be supplies expense. We record supplies expense when we use up the supplies, and then our credit obviously is to supplies because we're using it up. By crediting this asset, we are decreasing the current asset. And that would be our journal entry if we paid cash prior to the usage of the asset that we paid cash for. Okay, scenario number 2 would be where we incur the expense at the same time we pay for the expense. So in other words, if we bought supplies and used them right away, we could debit supplies expense. Another common one is rent, so we'll change it up and we'll say rent expense. So we pay for the rent and use it in that same month. So we debit rent expense. This increases the expense, decreases stockholders' equity, and credit cash, which decreases current asset. And that would be our journal entry if we incur the expense at the same time we actually pay for it. But remember, it's not the timing of cash that drives the recording of the expense. It's the incurrence of the expense. The third scenario is where we pay for our expense after we've utilized the expense, after we've incurred that cost. So in this third scenario here, we're going to credit cash, but our debit won't be to an expense. Instead, we record the expense whenever we incur that cost. So we know our expense is going to be over here. We'll use the example of, let's say, advertising expense. So we pay for advertising expense after, for instance, we run a billboard or run a newspaper ad or an online ad. So at the point at which we incurred the cost because we utilized the benefit of the advertising, right, then our expense increases, stockholders' equity decreases, but we don't pay for it immediately, so we're going to credit accounts payable. Again, purchasing this on credit. So our credit to accounts payable increases a liability. Then once we get to the timing of cash flow over here, we pay for the expense that we used already, and our debit then is going to go to accounts payable, decreasing that current liability. So far, what we've learned then is that the operating cycle activities are the primary sources of revenues and expenses which show up on the income statement. When measuring revenues and expenses, we could decide between cash basis versus accrual basis. But in a GAAP world, financial accounting world, GAAP only allows accrual basis accounting. The reason why is that on a short-term basis, accrual basis accounting provides better predictive and confirmatory value for the long-run goal of determining whether or not a company is going to make money. When we operate on accrual basis accounting, we follow the revenue and expense recognition principles. The revenue recognition principle has recently gone through some changes and now follows a 5-step process. We're primarily in this class, an introductory class, going to be focused on the performance obligation and when that was actually completed. We then follow the same type of rules that we learned in the accounting cycle from chapter 2, but this time we're focused on revenues and expenses. Remember, revenues and expenses exists on the right side of the accounting equation. So if we were to label this out, notice that we have both revenues and expenses right here on the right-hand side. Remember that the right-hand side of the equation in total increases with a credit, okay? But since expenses are in brackets here, they're actually going to increase with a debit. That makes sense because if we were to increase an expense, that decreases net income, decreasing retained earnings, and decreasing stockholders' equity. In other words, we still increase the right-hand side of the equation with a credit. Plus, to increase revenues, we credit, and to increase expenses, we debit. Remember, each of these can have 3 different scenarios due to the timing of cash receipts and revenues and cash payments and expenses. Ultimately, when we record the accounting impacts of revenues and expenses, we create the foundation for the income statement.